All right. Welcome, everybody. Welcome. Welcome to all of you here in the room in Dubai, and for all of you online as well. Thank you for joining us for the Climate Dragon's Den. So my name is Stefan Peters. I'm the CEO of the International Climate Finance Accelerator. And today we have a really nice show together for you guys. We have these ferocious dragons sitting here, and we'll have a couple of fund managers trying to ease them and get them all tamed. So today we'll have each of the fund managers give a presentation, a very short 5 minutes, to give a view of what they're doing, how they're going to engage, and what they're going to be raising. And we'll ask for comments and feedback from the dragons for another 5 minutes. We have 6 fund managers here today. This is our 2023 cohort who have the challenge ahead of them. Before we start, let me first give you a bit of an introduction about what the ICFA actually does, because that might be interesting for some people. So we are an independent non-profit association set up as a public-private partnership between Luxembourg government on the one side and various private sector parties who are active in the financial sector with deep experience in climate and impact finance. We were set up in 2018, we've been running for 5 years now, and we're very keen on keeping this going as well. So our main focus is to advance climate finance by building the climate finance leaders of tomorrow, empowering them and giving them support. So we are keen to solve one of the big market needs that we see. A lot of starting fund managers have massive financial burdens to overcome to actually set up a fund and get it up and running. So what we're trying to do is give them the support, the knowledge, the tools, as well as some financial support to overcome this process. So we work specifically with fund managers and advisors who are setting up their first or second fund. That can be still a pilot fund, for instance, but we're looking for scalable, innovative, and high-impact climate solutions. But it doesn't have to be necessarily incubation. We really work with teams that have experience, long history, and have crafted an investment strategy together and have tested it in small bits and pieces. And this is with the people that we want to work with and give a boost to accelerate them further. And you might ask, how do we actually do that? Well, we have 2 lines of support, essentially. The technical support. We give training, we give access to knowledge, we match them up with an expert coach. We help them with fundraising through warm introductions and getting to events like this to create a bit more visibility. And we also share communities of practice where we share insights. We do peer learning between this cohort and previous cohorts, but also in between different thematics. On the side of that, we also give financial support to each of these fund managers. We make available almost 280,000 euros for them to use partially to finance services they need or to have working capital to organize roadshows, go around, fundraise, and market. We've been up for 5 years now. In total, we've selected 34 fund managers, and today we'll be presenting the last cohort that we selected earlier this year with the 6 funds that you see here. Over that 5 years, we've had quite a bit of impact. We've actually given feedback and helped fund managers, almost 191 fund managers we've given feedback to. Of those, we have the 34 that we selected for further support after that. We've made available more than 8 million euros for support, financial support, and through that our fund managers have themselves managed to raise their funds of almost shy of $1 billion right now in commitments that they are currently starting to deploy. They're still busy, of course, because we have a lot of fund managers still fundraising as well, and in total they're looking to raise almost $3.6 billion in that process. For anybody who's interested in joining the next cohort and being on stage next year here, we will have an expression of interest is open right now until the end of December. It's a simple process to register and to put your expression of interest for. We'd love to see more fund managers come forward and help them along in this journey as well. But that brings us now to the more exciting bit of this event, where we're talking with the dragons. So let me give you a quick introduction to our dragons that you see in front. So our first dragon, I'm going by screen, so Carrie, you're first. Carrie Walczak from FMO, the Dutch Entrepreneurial Bank.
No? There.
Yes.
Okay. Good morning. I'm Carrie Walczak. I'm from our Sustainability Strategy and Policy team at FMO, working on climate and environment. But my background is actually in investment. I was head of project finance for many years, working in energy project finance. And I'm really looking forward to hearing what you offer today, both from an impact perspective and investment perspective. Thank you.
All right, welcome, Carrie. Our second dragon will be Stephen O'Driscoll from the European Investment Bank.
Hi, everybody. Can you hear me? Yeah, Stephen O'Driscoll. I'm head of Environment, Climate and Social Policy at the European Investment Bank. EIB has been a significant climate financier for many years. We issued the first green bond back in 2007, and 2019-20, we kind of transformed ourselves into the EU Climate Environment Bank. So it's the very heart of who we are now. So very much looking forward to seeing your pitches today. And I'm here, I guess, on behalf of the group, which includes both the EIB and the EIF, the fund, part of the group. So looking forward to this.
Right. Welcome, Stephen. Our third dragon is Eric Aleya, who is from DEG, the German investment and development company.
It's a very long German word, as we usually like it. Yeah, Eric Aleya, nice to meet you here. Very happy to be on this panel. I've been working with DEG for more than 20 years in different positions, a lot also in financing, Africa-related, and since a year also as senior impact and climate manager in infrastructure and energy. And DEG has a very strong and large fund portfolio. And yesterday we just signed an investment of $50 million in a net zero fund with AP Möller Capital. And that shows that we are really there to really support funds and to do our equity investments through funds. And increasingly really with net zero or clear reduction paths. And we support also funds in their transformation and in the transformation of their portfolio clients as well. So really curious to learn more about your funds. Thank you.
Excellent. Welcome, Eric. And finally, we have Arnaud Uzabiaga, who's here from Proparco, the private sector arm of the Agence Française de Développement.
Yes, correct. Where Proparco is the French DEG, and we're doing similar things to what FMO and DEG and EIB do in developing countries. I had the impact team at Proparco. We're a small team, and our aim is to put facts and data to confront and support the impact intuition that all our project teams have, and I'm sure all the fund managers have. So looking forward to the discussion with you with hopefully facts and data supporting your impact thesis.
All right, welcome, Arnaud. So don't let these friendly exteriors fool you. They are dragons and there's ferocity here. So let's start. We will have first presenting Anison Capital, Marlene Hermes. Give it up.
Hi, everyone. Good morning. I want to thank the ICFA for organizing the event. I am Chief Investment Officer of Anison Capital. Okay, thanks. And we are raising a $500 million fund in order to invest in renewable energy generation, mostly wind, solar, and hydropower plants in 3 target regions, and that is MENA, Sub-Saharan Africa, and Southeast Asia. We've secured our first investment from Riverstone, a large energy investor in the US. Now, our team has been investing in renewable energy for quite a long time. The pictures you see on the left-hand side are all of renewable energy projects financed by Cyril Arnauld in his capacity as head of GREF, which is a renewable energy fund out of the EIB, which he ran for 12 years. And so what we've done is we've partnered with 3 project developers, one in each of the key regions you see on screen from that original fund. And as such, we have an extensive pipeline of immediately actionable deals. So the problem we're trying to solve. The traditional funders of new greenfield investments in renewable energy in emerging markets are your DFIs. The development finance institutions, they pour money in at the top of the funnel in order to build the assets. And what they're finding is once these assets are built, they and the developers of the assets are finding that there are few, if any, buyers for the small to medium-sized assets. The problem is then that they can't monetize these assets and reinvest at the top of the funnel. And the DFIs are reluctant to invest additional equity before monetizing their existing investments. And so the result is a stalled ecosystem. The reason why this is important is that it means less funding to a sector at a time when we need more of it. We're aware that we need large amounts of private capital investment in order to limit global warming, and that renewable energy can replace fossil fuels at an attractive price point. So this is where Anison Capital comes in. Our strategy is to buy the smaller assets and to use commercial capital to do it, thereby injecting liquidity into the system and developing the secondary market for operating assets. As a result, we enable exits, thereby increasing returns, which in turn leads to new investors attracted to this sector, and it results in an increase in renewable energy investments in emerging markets. So let's take a look at the Anison solution in more detail. On the left-hand side of the screen, you see the leading developers of renewable energy projects in emerging markets, in our target markets, many of whom were financed by our original reference fund, GREF. And these guys are developing the small to medium-sized assets I talked about, call it under 100 million megawatts, because that's what the local grids can accept. On the right-hand side of the screen, what you see are the large institutional buyers of infrastructure assets. Because of their scale, they don't really have appetite for assets less than, call it 200 megawatts, sometimes even half a gigawatt of power. And so Anison aims to solve that disconnect between the sellers on the left-hand side and the buyers on the right-hand side. Our strategy is to buy the smaller operating assets that generate a lot of cash, return that cash to our investors while we build our portfolio and aggregate value, and then take them and bundle them later and sell them to the guys on the right-hand side of the screen. And so we've built in an exit strategy into our fund. On this slide, what you see is a breakdown of the different types of assets that we'll be investing in. Now, we've talked about the operational assets and how they generate cash. We also plan to invest in greenfield assets and in the project developers themselves. I mentioned on the first slide that we're partnering with 3 project developers, one in each of our key regions. And by doing so, we secure preferential access to their pipeline of greenfield investments. And as such, we've secured pipeline for each of the categories of the investments in our strategy. And finally, I'll talk a little bit about our team. The investment team has a long history of working together. 3 out of the 4 senior investment managers have worked with one another for well over 10 years. We also have local presence in our markets. Our head of Southeast Asia is based in Singapore, and myself, I oversee our African investments as well as my hat of CIO, and I'm based in Nairobi, Kenya. And with that, I encourage you to ask lots of questions. My contact information is on screen, and I look forward to opening up the session. Thank you very much.
Thank you, Marlene. Thank you, Marlene. Test, test. There we go. Thank you, Marlene. So, dragons, who wants to go first?
I'm happy to.
Carrie?
Sure. So, yeah, thank you so much for this very innovative proposition. And I think you're solving something that actually has barely been touched in the market, and then moving liquidity and also bringing in additional liquidity into this market is critical. And so I applaud you for that. Very exciting. I'm just curious what you think your key challenge will be going ahead.
Well, it starts with fundraising. And so the commercial capital that we speak to are very, very excited about this strategy. It's low-hanging fruit in the sense that the assets we're going after are de-risked. There's no development risk in these assets anymore. There's no construction risk on these assets. And they're generating cash. And so the message we're hearing is, we love it. Come back and speak to us after first close, because we're not a first close investor. Now, your traditional first close investors are on stage. Those tend to be the DFIs who are willing to step in as part of a first close. Now, their mandate, I used to work for a DFI. I used to work for DG for a long time. Our founders came from EIB. We're intimately aware with the mandate of the DFIs, and that is to really promote greenfield investments. Whereas our strategy focuses really on bringing liquidity and developing a secondary market for these assets. And so there's somewhat of a disconnect. Some can do it, and we're talking to those who can. And what we want to do is encourage more DFIs to really recognize this gap, this structural problem in the market, and help us address it.
Thanks very much for that. Very interesting, and indeed addressing the efficiency issue there. You've obviously got a very strong management team with former EIB people in there, of course, which is great. But you're looking to raise almost 3 times your previous fund. Is that too ambitious? Is it credible?
I believe that the JIRA fund was 280 million euros. And then this one will be $500 million. And the reason for that size is you want to have diversity in your operating assets, both geographically and across different technologies. And we believe that 500 million is the right size to start off with. Now, of course, we'll be accepting investments for a first close at an amount smaller than that. Eric.
One challenge we find in our equity investments in renewables in Africa, but also in other parts of the world, is sometimes the risk return. And basically, especially for secondary opportunities, I would be interested, what is your return expectation, or how do you match this with the risk?
Okay, let me go back to this slide. And so the idea of complementing operating assets with greenfield and investments in project developers are to boost the returns. We're targeting double-digit returns. And the way we get there is the operating assets help deliver cash from year 1. And then the greenfield assets, remember, we're securing pipeline by investing in the developers. Investments in developers come with a higher return profile. And the greenfield assets supplement those returns. Now, the key here is that the operating assets that we're targeting, it's a buyer's market for those assets. There's a lot of willing sellers, and they're willing to sell at a fair price, an attractive price to ourselves. We then bundle those operating assets with greenfield and investments in project developers that bring a higher return. And that's how we get to our double-digit target.
Now I feel bad because you answered my question. I like the idea of the secondary fund and solving the issue of recirculating the capital, but I was wondering why are you, if it's really the impact thesis, why are you targeting greenfield projects? And I was wondering if it's just a bait to catch your DFIs on the...
It's a 20 to 23% IRR, and you need the greenfield in the math in order to get there. And so the way that we're thinking about risk and return has to do a lot with our geographies. So take Southeast Asia, which has historically been a lower risk geography than, say, Sub-Saharan Africa. And so what we'll do is focus our greenfield investments in Southeast Asia, which is a lower risk geography. In a higher risk geography, say Sub-Saharan Africa, we'll focus on operating assets that are de-risked and generating a lot of cash. And that's how we match the risk-return profile with the demands of a commercial investor who are seeking 20% plus returns.
All right, thank you, Marlene. I think that wraps it up for Anison Capital.
Thank you very much.
Our next fund manager will be Maud Savary-Mornay from Beyond Finance.
Good morning, everyone. What a powerful speech we had so far. So let me find out where is my, no, forward. Yes, here we are. So let me bring you with me on the field. And first a question. How many of you have already done a due diligence in an emerging market? Raise your hand. 1, 2, 3, wonderful. Do you recognize yourself in this picture? Here I am, probably a bit younger, right? And in front of me are women who are all clients of this microfinance institution. Next to me is a loan officer, a man. And when I will go back to the headquarters, I will have conversation with the board, with senior manager, with loan officers, all likely to be men. What does it bring as a question? How well are these institutions or companies prepared to understand the needs of their female customers? How well are they prepared to design and develop products that meet the needs of women in emerging markets? And even the next question, how well prepared are they to develop products that contribute to climate resilience? We are a team of women with a very strong experience in emerging markets, working for a very large asset manager with more than 4 billion assets under management. And our combined expertise lies into financial inclusion, climate finance, sustainable agriculture, and access to clean water. I'm based in Hong Kong. My partner Camille is based in Paris. We are also supported by a very strong team of technical advisors. Some of them are former colleagues, so creating a great pool of talent and expertise to support us. And I'm pleased to announce that we are just agreed a very important partnership with a very reputable institution whose name I cannot disclose yet, but bear with us, it will be really an exciting partnership. Why is investing in women a fantastic business case? Well, actually, companies who have more women in the senior management or in the board deliver better returns. They have also better results in climate footprint. And in emerging markets, women who are early adopters of climate resilient products are also much more likely to influence positively the adoption of these products to their family, to their communities. So it's really women at the center of climate action. So I'm mentioning climate and climate resilience. What are we really looking at? Today, it's a huge opportunity as private funds are actually under investing in sectors such as agriculture, only 8% of current assets under management, such as access to clean water, even less, 2% of the current asset under management, while there are actually very exciting solutions contributing to climate resilience. Here on the right side of the screen, I've indicated 2 examples of business we are very excited about. Water kiosk, water filter, all that has a very positive influence on women's livelihood, but also on climate resilience. So, how did we incorporate gender and climate into our investment thesis? We have actually designed and tested our theory of change, where we focus on companies that disproportionately benefit to women and climate resilience. We also align with the 2X challenge, if you are familiar with that, leading to companies in sustainable agriculture, in access to clean water, clean energy, and also financial inclusion. As financial inclusion is actually a great tool to disseminate products and services to the last mile and to women in emerging countries. So what are we trying to achieve? We want to drive them to have a better understanding of the needs of their women customers, but also to unlock the power of gender lens, so having more women in key positions, board, management, client design, product design, and client-facing solutions. How are we going to achieve it? KPIs. We set KPIs to these companies. We also give them an incentive. Spread reduction if they achieve their KPIs. And because it needs some support, we have also designed some technical assistance to help them along this journey. We have an actionable pipeline, companies we know really well, in financial inclusion, climate finance, access to clean water, and sustainable agriculture. So, what are you looking at today? The next generation of transformative impact funds. We have designed it as a pilot, 80 million, pilot which is meant to be replicated to other geographies and other sectors. 40% of our pipeline is direct investment into companies. So again, access to water, agriculture, clean energy. And 60% goes through microfinance institutions. Are they a great tool, great factor to disseminate this innovation? Emerging markets, 80% in Asia, where I'm based, and 20% opportunistically in sub-Saharan Africa. So we look at a transformative mechanism and really emphasis on transforming. KPI link loan and technical assistance to achieve it. By nature, it's a blended finance solution. I mentioned technical assistance. We have also designed a junior tranche to allow to take more risk, go into direct deals, and also build a track record, for example, for companies working in the field of access to clean water. We have been supported from day one by Convergence, by ICFA. We have also a label from UN Women. And, as I said, exciting partnership to be announced. So thank you for your attention. Dragons, feel free to throw your questions. And I'm looking forward to this conversation with you.
Thank you very much. Really interesting. The just aspect of the transition is very important to us as the bank. It formed a central part of our climate bank roadmap, which was about how we operationalize our commitments. Everything we do has a gender lens to it, and we just actually announced our Just Resilience approach for outside the union at COP28 this year. You mentioned KPIs.
Yes.
How do you intend to actually show and measure impact and resilience?
Yes, KPIs are really at the center of this transformative aspect, and measurement as well. If you don't measure, you don't transform, you don't know actually what sort of impact you are really developing. So part of this transformative aspect is that we want companies that are ready to embark with us on a gender and climate journey, right? So being willing is actually a very important selection criteria. We have devised a grid of KPIs, which is based basically on generally accepted standards. Take IRIS Plus, which was developed by the Global Impact Investment Network. Take more specific standards such as the 2X and SWIFT, which has done a lot of work in gender. And we have developed a full grid of criteria. We will plot basically companies in this grid, and we will define with them a roadmap. Point is, it's not one solution fits everyone. Every company is differently positioned in gender and in climate, so that's where we pick them, and we set KPIs that are ambitious, yet realistic, and that's very important, makes a strong business case.
Thank you.
I can go next. Well, thanks for the presentation. I think one wouldn't be a question, but you say I really like the gender angle, and you say you're aligned with the 2X challenge. I think you're being too modest. It looks like you're taking the 2X challenge. For those who don't know, it's like a global initiative. Propaco was one of the founding members, and now it's becoming the main gender standard since they merged with Gender Smart. There are 5 criteria: ownership, management, employees, consumption or access to essential goods and services, and the other one is for intermediated finance. I think you're ticking all the 5 boxes.
And women founders, that's us.
Yeah, so to my knowledge, it's probably one of the, if not only one of the few funds doing this. I would put focus on the criteria for the consumption and access to essential goods and services that disproportionately benefit women.
Correct.
And I mean, you said it, but it's everyone talks about women founders or women in top management, but this is really the poor kid in the 5 criteria of the 2X challenge, and the one we should try to uplift, because in the end that's where we have the impact, and that's where the outcome is. So really.
So do you have a question? Or?
No, the comment is, I mean, Stefan said, be nice dragons, so not always flames. I said that it wouldn't be just a question, but the comment is, don't be modest on your, not only being aligned on the 2X challenge, but also being one of the few that do tackle the outcome issue and women beneficiaries in the end, because it's what we love the 2X challenge, but sometimes it's only woman owner or woman top few people.
No, thank you. And actually, you're absolutely right. I mentioned the 2X because it's known, because it's a standard, but it's a floor as well, right? It's a common language. And actually, we are way beyond the 2X challenge. We use it as to explain basically why we are focusing on companies benefiting disproportionately women. And also, our set of criteria is aligned somehow with, the main criteria, the 5 criteria dimension you mentioned. But de facto, we are way beyond. Was a minimum standard of the 2X challenge. So, and thank you for mentioning it. And I gracefully take your comments.
But if you do want a question and some flames,
less modest
I can put some flames and be a dragon, because I see your question. Well, not your question, but your introduction, when you say, look, this is a woman on the field doing due diligence with women and bringing back a project to the investment committee or board. But you could see it with a broader inequality or inclusion mindset. You could say it's an upper class woman going on the field and bringing upper class solutions to a board or investment committee of upper class people. How can they?
Actually, you're right, and we really want to avoid any solution that falls from the sky or falls from this upper class, as you mentioned, right? It has really to come from listening to the voice of women on the field, understanding their needs, and really finding out which solution works for them. And it looks simple when I say it, but we all know, and you all know as well, that the world, it doesn't work like that today. Structurally, it doesn't work like that. So we want really to support a solution that structurally address these issues.
Yeah, really fascinating concept, and also I very much like this transformative aspect of your concept. I just wonder, and maybe you can shed some more light on it, what kind of companies do you focus, or what size are they? Is it whatever, and what do we have to have?
So
what are the main challenges you also encounter with these kind of companies?
I'm happy to answer this question. So 60% of our portfolio is currently in microfinance institution. It's mostly tier 2 financial inclusion companies which have been in this space, in their market for a long time, are mostly focusing on women customers, are not necessarily that attractive anymore for large impact funds who have moved up to SME banks or other type of segments, and are let's say, climate aware. They know their clients are facing issues, but they don't necessarily know how to tackle it. And no one has really asked them as well, to look at the needs of their female customers and look at if they need access to clean water products, if they need other type of climate resilience solution. So we hope with this transformative mechanism to really bring them to this level, looking at their clients as women, understanding their needs, and packaging and devising products that work for them. That's for the 60% of our portfolio. The rest of our companies, of our portfolio, so 40%, it's directly companies operating in this space. I show a picture. I know you are not particularly well placed to see the picture. I show two examples. For example, in access to clean water kiosk, and water filter. So you have today's companies, for example, in Indonesia, doing some water filter. It's a cheap solution that works very efficiently and has a very huge impact on women, because they don't need to go and fetch the water somewhere and boil it when they come back and use fossil fuel to do it, which all sort of negative impact on environment and on their health. So that's exactly the kind of company we are looking at. And for a ticket size, I did not mention the ticket size, of let's say 0.5 to 2 million for these direct deals. For microfinance institution, we can go higher, I would say up to 5 million.
Okay, thank you.
All right. So we're running a bit over time, but I still want to make sure that Carrie gets a word in as well.
Yeah, maybe I'll just comment then, since we're running out of time. I mean, I really applaud this initiative, and when you mentioned it's the next generation of blended finance, I agree. I think it's very thoughtful, and it really targets something where there's a need and hasn't really been done well yet. And you didn't talk about your experience, but we had the opportunity to speak before, and you see your experience through it, though, in the way that it's structured. So maybe, next time you can also add that into your slides. It's just a comment, but very good job. Thank you.
Thank you. I take it gracefully.
All right.
Thank you all.
Thank you, Maud. So now we're moving on to our third fund manager, Catalyst Investment Management from Jordan, Anis Rimawi.
Thank you, Jacobs, for passing out water. No, I really have to express my gratitude to ICFA and the Luxembourg government. Stefan Jacobs, the ICFA team has been amazing. I wish I had $1 billion to invest in all the funds, because every time I listen to the pitches, I'm super motivated. We have Jennifer here from the Ministry of Finance, by the way, who's been a key supporter and the originator of the ICFA concept. It's a pleasure to be here, and we have a lot of gratitude also to the EIB, one of our existing LPs, who supported us, DEG and FMO. So we're very happy to have had your support to get us to where we are today. We're a Middle East, North Africa focused climate infrastructure fund manager. Our strategy for our follow-on fund, and this presentation is for our follow-on fund. Our current fund was $57 million equity. The follow-on fund will continue to focus in the same sectors, renewable energy primarily, energy storage, energy efficiency as a secondary area, and we've added water treatment due to the water scarcity issues in the MENA region. It's the most water scarce region in the world, and there's a convergence between water treatment and renewable energy, meaning you're having now water treatment projects that are driven by renewable energy. For example, in Egypt, there are 21 concessions coming up alone that are directly or indirectly driven by solar. Ultimately, we invest in projects, infrastructure projects with long-term offtake agreements. And these would be, actually, I'd reaffirm what Barlene said. It is the 20 to 200 megawatt range that are considered small to medium small and below the radar of the big guys who have a low cost of capital. So as a result, we're seeing higher margins on these projects, both in greenfield as well as brownfield. And our strategy is essentially to de-risk these projects, enhance them, aggregate them, put them on a silver platter for dragons. And that's what we did with our current fund, and resulted in a 15.5% net IRR realized in US dollars, and we still have one more portfolio company to sell. And we're applying the same process. This fund will be bigger, $200 million. And we are hoping for first closing in H1. We have some support from new LPs, board approvals, but we continue to need further capital for first closing. Just really quick on performance. On a realized performance puts us in the top quartile. This is per Preqin for our versus our peers for infrastructure funds. We're also measuring non-financial outcomes for the follow-on fund, where we have an impact department, where for the current fund we didn't. And we'll also be adding other impact areas like the water scarcity and female inclusion. Our background dates back to 2006, where I grew up in the US, moved back to Jordan as part of a tech company turnaround, my Boston company with a Jordan operation. Once that was turned around, wanted to be on the other side of the table, wanted to be the investor I wish I had. So we launched an energy water tech fund. It was underfunded, first time fund, too early. But that's how we got into renewable energy, through our 2006 energy water tech fund in solar thermal. Once solar PV became commercially viable, 2009, 10, 11, 12, we ended up developing some of the first solar PV projects in the MENA region, because Jordan was a first mover in that sector. Utility scale commercial projects with non-recourse financing, and we developed the first private sector off-taker PV project with non-recourse financing in the MENA region, and then we launched our 2016 fund. 10-person investment team, 10 years experience on average tenor for the senior team, and mentioned track record. And our blue chip support, we have board approval from the Asia Infrastructure Investment Bank for 20%. We have board approval from the Austrian Development Bank, and we have other LPs in process. Strategy, primarily greenfield, up to 25% brownfield projects. So these are infrastructure projects. Equity ticket, $10 to $20 million. We are adding to our strategy platforms. So we will be investing in platforms in the CNI area that's more distributed, and we'll be looking at a brownfield platform, hopefully, co-investing with Anison and other larger investors that can carry on the platform after we meet our limits. The MENA market has been the top performing IPO market in the last 2 years. So platforms are also offering the opportunity to exit through a listing in addition to a strategic sale. And we've seen now multiple data points of platforms being sold for premiums. So we're not just, so typically we have about a 14% levered equity hold IRR, aggregate the projects, and we sell to a buyer that's willing to buy at a 7.5%, and that's what we just did recently, and we get that premium. On the side of platforms, we're seeing further premiums for platforms because of the pipeline and management team. So that's why we encouraged to also develop in our portfolio a couple of platforms. Where on the investment cycle do we enter? I mean, we started developing from scratch projects. In our current fund, we thought everything would be developed greenfield from scratch. We realized there's a sweet spot, greenfield, but ready to be financed greenfield. So then we take a lead on the project financing, the construction, and then operations enhancement. So it's that middle area where it's not early stage development, it's kind of pre-financing, pre-construction, the critical area. And because we've been in the region since 2007 in renewable energy, initially in solar thermal through our very old fund, we're known in the region as a reliable buyer and a reliable partner. And we've worked with multinationals that, you name it, fantastic people. We've learned so much from them. Neoen from France, Marubeni. And they'll be very keen on a domicile, a country, a region. We'll develop a project together, secure it, and then strategy changes. They leave. Or similar to also Marlene's point, the $20 million ticket is no longer of interest, and that's happened a few times. Neoen, we had a project with Orange, the telco. All of a sudden, when we had challenges on this 35 megawatt project, they said, look guys, we closed 300 megawatt in Mexico. See you, bye-bye. Marubeni, it was a 65 megawatt project. DD, SPA, conclusion, in process. Guys, we just secured 800 megawatts in Qatar. We don't have the time for half a 65 megawatt project. So that kind of small to mid market is a sweet spot, and we get most of these opportunities on an exclusive or limited competition basis, because our reputation is that we're not going to pay the highest price, but we'll get the deal done. We know the market, we know the players, and we're present, and that's what we did in Egypt when we entered. And as I mentioned, we enter at close to a 14% hold IRR. For the new fund, it'll be a 12 to 14. We enhance, we de-risk, we aggregate, and we exit. So we'll be repeating the same process. It's a formula, it's proven. Very active secondary market. Very active secondary market. And all the players at the bottom have been very active on standard renewable energy projects. The Japanese, the Koreans, the Chinese, the French, and the regional players, Masdar and Aqua. But again, nothing less than 500 megawatts, and that's increasing over time. So we're very happy about that. They've moved out of our kind of space. In our space, we have a few of the smaller funds, very few, and local developers primarily, a lot of which don't have a lot of experience. In the market, the MENA region is going from 4% renewable energy in the electricity mix to close to 40% in the next 15 years. You have 10x growth coming. So you need everything. The chart on the right shows you that, the yellow, orange at the top and the blue, that's solar and wind from 2024 into the future. So significant growth, and that's without the other phenomena, which is the MENA region is the neighbor of the EU, and the MENA region will be supporting EU's energy crisis. Initially, green hydrogen projects, which are already starting in production, smaller ones in Egypt, and then direct transmission lines, 2028, 600 megawatt line from Tunisia to Southern Europe. There are 9 gigawatts of transmission lines being planned from Egypt to Europe. So there's the local market, and then there's the export market. Our pipeline, 15 active opportunities diversified by country, by technology. Team as mentioned, 10-person team. We've learned a lot. We had challenges in our first fund. We agreed with our LPs, we'd upgrade. We brought in independent IC members. It was a fantastic learning process. Now we're hitting best practices across the board. We have fantastic independent IC members. Tom Murley deployed over $1 billion on a commercial basis in Europe in renewables. And FMO actually then secured him to represent them in another portfolio company. So we have a fantastic team, all locally educated. I'm the only semi-expat on the team. Impact, I mentioned some of the metrics. We've defined impact targets across these metrics that include water scarcity, infrastructure resilience, and increasing female inclusion. Not to the level that Maud is doing it, so I think Arnoud, we're babies compared to her level of impact on the gender side, but we're trying to do our best there, given our asset area. That's it. Thank you very much.
Thank you, Anis. So, Dragons, any comments, insights?
By the way, we take credit cards as well.
I'm happy to start. Yeah. Thank you very much. I think it's great that you're building on the track record you have already. That's also important in targeting this middle market. I'd just like to understand a little bit better how you see your role, because I hear something between, being a fund, but also, almost being a support to local developers. So maybe you can give us a little more insight into your role. And second, well, actually, I'm going to stop there. That's fine. Thank you.
I mean, we see ourselves as primarily a renewable energy infrastructure investor. In the sense where you have new markets like Tunisia, you have very inexperienced developers. Certainly, the same way we learned on our 2014 PPA when we brought in an experienced Italian developer. We expect that the developers we work with will grow when they work with us. Now, we expect to have a majority stake, and that's what we have. 80% of our current projects in our current fund, we had 100% shareholding. But ultimately, we expect the players we work with in immature markets to grow through that. But primarily, we're an investor in projects. On special occasions, we'll do the development from scratch, and these are the more innovative areas. And we like to push the edge on the more innovative areas. That's why we have energy efficiency in our scope. That's why we have solar-driven desalination in our scope. We signed an MOU where we'll be developing a smaller green hydrogen project. We signed an MOU yesterday with the Minister of Energy in Jordan. We also were part of an MOU with the Canadian government and Jordanian on energy efficiency. So we like to do the more innovative. This is maybe the older tech background, the MIT background, that we don't want to just, we prefer not to just do the standard stuff. We mostly will do the standard stuff, but we like to push the border, like we did to have the first private sector PV project with non-recourse financing. So we like to be on the more innovative area. Thank you, Kerry.
2 questions. First, how do you see the new, say, interest rate environment impacting on renewable power projects? Is it being reflected in the higher tariffs, or are returns being squeezed? How do you see this? And the second one, you started with solar thermal years ago. Where is it? Is it still there?
Yeah.
Is there a future of it, or what's your view?
Yes. Look, I agree with Marlene. It is a buyer's market. It is a buyer's market. So we've had COVID, where a lot of PV prices, equipment prices went up, and all of a sudden projects were no longer feasible, the very low bid projects. So actually pricing in the market did go up. Now interest rates are even higher than they ever were. Of course, we look on a 18-year basis for these loans. And so they will average out and average down when we use these projections. On average, though, we feel it is a buyer's market. Prices aren't as low as pre-COVID tariffs. They've gone up a little bit. And we do think it's attractive. The good news also, PV panels. We just met with the regional head of Jinko, which used to work for us 15 years ago. And he was telling us now 10 cents per watt. 10 cents per watt. So before COVID, it was around 16, 17, 18. During COVID, 24 to 27. Now we're less than half. And the Chinese are going big, and so is everyone else, on lithium ion and battery storage. And so we're going to see those prices go down. So we're going to see a very exciting period for renewables. As the cost has come down, the government and private sector off-takers will have significant commercial incentive to pursue it.
Yeah. And so is there still a role for solar thermal? If prices of batteries and PV go down?
I'll tell you, Eric, on solar thermal, we've never used it for power generation. It's been mainly for industrial heat.
Okay.
Hot water for hospitals, universities, commercial scale, including the world's biggest in 2011 was one of our portfolio company projects. 25 megawatts solar district heating, 90 degrees Celsius.
Yeah.
That's where it's efficient.
Yeah.
It's efficient if your end use is heat or steam. And we have projects in our pipeline there, but it just takes longer. It's a newer area for the market. Yep.
All right, thank you, Anis. Sorry, guys, we're running out of time here. So for next, I know, Stephen, you get dibs on the next one. Let us all thank Anis for his insights.
Thank you.
Our next fund manager is for Cycle Group, Johannes Peshko. Give it up.
Good. Hello, everybody. Good to be. Hello, everybody. Good to be here. Okay, so now I can be heard. Thank you for having me. Yeah. Why am I here today? This is because energy systems are changing massively and rapidly, and they need you. We have heard that numerous times at conference that this is a very, very important topic, and we have the skills and the experience to be part of that transition. So I brought you one number today, which is this 131 with a lot of zeros. That is 131 as in trillions US dollars, which is one estimation I found for how much investment is needed in energy assets until 2050 to keep the 1.5 degrees Celsius target. And that obviously means that there's lots of investment needed to be done and lots of things to be done. And one of the most important questions that is driving us is that where are those technologies that are being deployed there? Of course, it's wind and solar, but it's much more than that. And there's many technologies that are not yet being developed or that are currently being developed. And the question is how to de-risk those and bring them into markets and make them bankable. And this is where we are coming into play, because many technologies are being deployed for the first time. Yeah? So who are we? Cycle is a venture capital fund investing in climate and deep tech companies. We are a second generation SFDR9 fund, so we're a first generation fund. 100% of our investments are going into clean tech investments, so we're purely doing clean tech and impact stuff. And we have dedicated ourselves to contribute as much as we can to halve emissions by 2030. Yeah? So we are doing 100% equity investments in late technology development and early growth phase. So we call it the second valley of death of technology development, which is where you are going out of the lab, where you're going into the market, and when markets need to adapt your technology. This is when banks usually say, okay, this is scary because we haven't ever heard of that. Yeah? And this is where we invest into companies. We are based in Luxembourg. The fund size will be 120 to 150 million. We will be investing into 12 to 15 companies, and we will be deploying 5 to 50 million euros per company. So our investment focus is mainly on Europe, but not only. 60% of our investments will be in Europe, 40% will be outside of Europe, mainly in Asia. And there's a specific reason for that, because two of the founders of Cycle Group have a lot of experience in Asia. They have founded companies, they have scaled companies and IPO'd companies in Asia. So we know how to bring companies to the market in Asia. And this is also what we're helping our portfolio companies with. It's not only financing, but also to help them to internationalize, to become bankable, to build good companies out of the technology that they have invented. So what is our areas of investment? We have two main focus areas. One is decarbonizing energy systems. This is things like green electricity. This is things like sector coupling. This is thermal efficiency. And we have a second one, which is use of resources and energy. We have a lot of energy efficiency, semiconductors company, or circular economy. So by the way, all the pictures are from actual portfolio companies of ours. Yeah. I brought you one example because I find that personally pretty compelling. Have you ever heard of SF6? Most people won't. SF6 is a gas that is used in electrical switchgear. So every time you have a mid or high voltage switchgear in any kind of electrical system, electrical grid over the world, there's SF6 gas in there. The problem with SF6 is that its global warming potential is 23,000 times as high as CO2. So again, 23,000. And we were researching the market for a company that is developing switchgear that does not use SF6. And we found one in Berlin, actually pretty close to my home. And we invested a couple of years ago, and they are developing now. I brought you more examples, but in light of time, I don't want to go into any of those. Of course, we are not operating in a silo, so we have lots of good co-investors, a very, very big network of co-investors being institutional, energy companies, finance companies, in our first funds, in our past investments. And we have a very big support network in Asia from institutes, banks, corporates, etc., to help grow our companies there and bring them to the markets there. So who are we? Us at the moment is a group of 5 people. We have 2 seniors helping us grow with a lot of experience, and we have 3 main operating partners, me being one of them. And together we combine more than 20 years of investment experience. We have done more than 20 fund generations. Maybe most importantly, we are not purely finance people. We mostly have an engineering background and have been or are entrepreneurs ourselves, not only in the fund but before. And so we understand how companies are growing and how technology is working. So thank you very much. Looking forward to questions.
Thank you.
Thank you very much indeed for the pitch. Some of the processes you're targeting there are potentially very high emitting, so can have a major impact on the on mitigation. So, and you say in your documents that you're having trouble, or you're sharpening your impact strategy so that you can attract impact investors. Why is there some kind of misalignment at the moment with impact investors?
There's no misalignment. No, so we are. So the process is everything that we are targeting. For example, if these take one investment into an electrolyzer company, which is just like for the entire hydrogen value chain, and we're not having problems targeting impact investors. Okay. That's not it. No.
Yeah, thanks. Well, due to our geographical mandate, I feel less qualified to ask you questions than I would have been to Enis. But my question to him was about integrating climate risks in the due diligence process, and as I think it's a global issue, and I think we can learn from maybe what northern investors are doing. So how's your process to integrate climate risks in your due diligence?
So as I said, we are doing purely 100% climate neutral investments. So if you go and look into those companies, all those technologies are potentially at least reducing emissions. Yeah. So
maybe just to for the sake of time, I meant your exposure to climate risk and your supply chain, and maybe the whole value chain of the companies you invest in. I guess you're exposed. Everyone is exposed to the consequences of climate change. Do you factor it in your investment process?
You mean by deploying companies and then being?
No, it's.
Sorry, I'm having a difficulty understanding the question.
My question is: the climate is changing.
Yes.
Your value chain, or the value chain of the companies you invest in, they get goods or materials coming from China or India, wherever.
Yes.
Are there supply chain, or do you consider the adaptation of their supply chain to a changing climate, or is it still a blind spot?
Yeah, there is yes and no. It's both. So what we are taking good care of, for example, in those hydrogen or electrolyzer investments, is that we invest into technologies that don't use too much rare metals, for example, or rare materials, which are difficult to get already. So because they tend to be expensive and it's hard to scale those technologies. So we've done like methanol fuel cells, for example, or electrolyzer companies. And one of the selection criteria always is to have a sourcing strategy for those things that is robust and then in the end also cheap. It's also a pricing problem.
Yeah, Martin? Okay. Thank you very much for your presentation. I think it's interesting because as climate's changing now, it is a dilemma that you're actually addressing, that we need new technologies quickly, and then how do you actually finance them and make them bankable, and that we move the system faster. So I think it's quite interesting. My question to you is about your markets. So I think that you mentioned you'd be investing mainly in European and Asian markets, but that it would be international over time. But I wondered how different the markets are, how applicable is it, how much technology transfer there is, or whether it has to be more geographic specific to be able to expand?
So we are physically based in Europe and in Asia. So one of the partners is living half of its time in Asia. So there is a very close connection to those markets. And of course, they work completely different. Yeah? So I mean, I am German, and just one example, we developed with one of the portfolio companies a power-to-methane project in northern Denmark. We started to develop that in 2019. This year, we got a grant for subsidy for the hydrogen that we produce there. So it's 2023, end of 2020, that's 4 years. Yeah? Why is that? Because this is a first of its kind project. And first of its kind project in a European environment is always taking a very long time. So that is a bit different in Asia. And once you are through the door in Asia, the market is just much bigger than the European market because it's just many more people living there. Yeah? And this is one of the reasons why we are having the strategy.
Yeah. Thank you.
All right, I think we are done. Thank you so much, Johannes. So now we're moving on to our fifth fund manager. We have Mido Talhouni, who's going to present Ship2B Ventures, and Mark Sabas, who will be online to help you with Q&A as well.
Yep. First of all, I'd like to thank the ICFA for the invite and the Dragons for joining us today. My name is Mido Talhouni, and I'm here to present the 1.5 degree fund. The warning is there. We all know what this graph represents and where we are heading if no further action is taken. We are here as we believe that venture capital can play a significant role in shaping that red curve. We believe that investing in disruptive innovations and supporting the right emerging climate technologies will ultimately allow us to achieve our net emissions target. Although we are seeing more and more venture capital going into climate tech solutions, we are also seeing that this capital is being concentrated into a number of sectors that aren't having the biggest impact. In fact, the sectors generating more than 70% of emissions have so far received 25% of VC funding globally. With that in mind, we see a clear opportunity in the market. Ship2B Ventures, the largest impact VC fund in Spain, and Climate Cake, the EU's largest public-private initiative focused on climate innovation, have signed a strategic partnership with the objective of addressing this gap in the market by investing in disruptive innovations in overlooked areas. This collaboration brings together two leading like-minded organizations to build an unrivaled climate tech VC fund to support emerging technologies in these overlooked areas. Ship2B Ventures and Climate Cake are therefore launching the 1.5 degree fund, a pan-European 50 to 70 million VC fund focused on pre-seed and seed stage investments. The focus is on the three core systems responsible for 70% of emissions. These systems are how we eat, the food and agri-tech, how we live, the built environment, and how we make things, the decarbonization of industrial processes. The fund will look to target bold entrepreneurs with 10x disruptive solutions, and therefore will not shy away from investing in deep tech and hardware companies with potential for systemic impact. We aim to achieve this by adopting a scientific decision-making process to maximize for impact. We look to apply a smart gender lens, and we're looking to tap into Europe's full potential by looking at less developed ecosystems, such as the IT regional innovation countries. Our North Star is to save 3 gigatons of emissions by 2050, but by that we also expect some positive collateral effect in the form of systemic change and attractive financial returns. So what does this mean in practice? How would that work? Well, Climate Cake have been developing thriving climate tech ecosystems for more than 10 years now, having developed multiple entrepreneurship programs to support emerging impact founders across different stages. These programs include the Climathon, a capacity building and incubation program, the Climate Launchpad, an incubation program, and the Climate Accelerator, the flagship accelerator program supporting 250 plus climate positive startups a year. The startups coming through these programs will develop into the pipeline for the 1.5 fund, which along with the external deal flow coming through from the Ship2B network will create a unique and diverse funnel of some of the most exciting innovations emerging from across Europe. The 1.5 fund team will then assess the best performance coming through these programs with the aim of investing in the climate outliers of tomorrow. This has already been demonstrated with the likes of Climeworks, Thermondo, and Insect, category leaders today which have gone through the Climate Accelerator programs in 2013 and 2015 when these sectors were really unknown to the world. So what makes this fund different? What is our USP? Well, it really lies within this collaboration, which builds on the strengths of both organizations. On the one hand, Ship2B Ventures brings in the investment experience, having developed a proven and validated impact investment methodology where they have invested in more than 50 investments over the past 5 years. On the other hand, Climate Kick combines the depth of the key relationships that we have along with the breadth of the infrastructure that Climate Kick has built over the past years, which includes 12 offices across Europe, 70 plus entrepreneurship support organizations, and 200 industry leaders. Together, we have unparalleled access, visibility, and insight across the European climate ecosystem. Together, we are the 1.5 Fund, a highly qualified, mission-driven team. Investments will be led by Mark Savas, the current vertical lead at Ship2B Ventures. I will join Mark as part of the investment team, and we will receive the ongoing support and commitment from both organizations in the form of operations, impact, communication, gender, policy, and many others. We spent the first half of this year developing the fund thesis, and a few months ago we started with our fundraising campaign. We're now talking to anchor investors. We hope to go on a roadshow early next year with the aim of first close by Q4 next year. Thank you, everyone. And happy to answer any questions. We should have Mark join us virtually as well. Not sure if that's happening, but please go ahead with the questions.
Thanks very much. It's certainly a powerful partnership with Climate Kick into the European network, so that could be very useful. I was going to ask you about the methodology that you use when you're actually screening all of these companies, quite a significant number of companies. Have you got a specific methodology for doing that? What criteria do you use?
Yes, so a lot of these companies, as I mentioned, are coming through our programs. And when they come as part of our accelerator programs at Climate Kick, what we do is an impact validation to all these companies. So we do an LCA for the startups. And so once they come through to the fund, they feed into the fund, they've already gone through some sort of assessment, they've already thought about their theory of change, and we have a good understanding of what sort of impact these startups could bring to the table. And then once we take that into the Ship2B investment team, then they also have an impact investment framework that they've developed over the years. And maybe Mark, you can talk to that about how you look into investments and particularly the framework that you've developed. You might be on mute or...
Yeah, good?
Yes.
Better, yes.
Thanks, everyone. Yeah, so as Ship2B Ventures was created as a foundation over 10 years ago, and so we've been kind of working on our impact investment methodology since then, and we've developed our own framework that spans across what are the things to look for in both origination, deal screening, portfolio management, even on the exit part. I'm happy to go in more detail in a separate conversation.
No. Thank you.
And has the investment team already executed investments in this kind of industry? And what was the lessons learned or the experiences with it?
Yeah, so for sure, I have 7 years experience only in the climate and energy space, or sustainability space, I should say. I've been invested in over 30 companies in this space, and particularly in the areas that were harder to abate, in the high tech and deep tech. These are the kind of investments that I've been doing mostly in the last couple of years. But not only from my side, the collaboration with Climate Kick has allowed for them to identify some of these deals that are already coming through their deal flow, and they have already actually made safe notes into some of these companies, which basically like we're housing some of these deals for the future of the fund.
Mm-hmm.
I was curious about what types of investors you're targeting for your core capital. Who's in this space right now? What direction can you go in?
Yeah. So we're targeting, I guess, a diverse LP pool. So we're looking for investors from across family offices, already successful founders who exited their business in sustainability. But also for large financial institutions or groups, corporates. What we're thinking about is we would need corporates to join us as well, particularly corporates related to the 3 core systems that we are focusing on. But of course, we'd love European financial institutions to join us, so we're talking to some of the groups here present, and I think we definitely need an anchor investor that from Europe to enable to take this forward, but then hoping to get investors from other regions as well. We see a lot of interest from groups from outside of Europe who want access to innovation emerging from Europe, and we think we can provide that because we really have access across Europe, and not just the more emerging markets or developed markets, but also innovations that are coming from places like Bulgaria, Romania, Lithuania, where we see a lot of exciting companies come through there. And so the whole thesis is that we really can give investors access to these companies as well.
All right. I think that wraps it up for this particular one. Thank you, Mido. Thank you, Mark, so much.
Thank you.
And now, our last fund manager will be joining us online, straight from Mexico. We have Laura Ortiz Montemayor from Social Venture Exchange Mexico. And we have to give her credit for her dedication because it is now just before 3 a.m. there.
Oh.
My pleasure to be here. Thank you. So I am connecting from Mexico City. I'm a mompreneur and the founder of SVX Mexico and the managing partner of Regen Ventures. And I have a question for you. So how many of you have put your hands in the soil? Anyone here? I have. Okay. So I'm proud of you. And I just wanted to let you know that each one of us knows how to recognize the smell of fertile soil, precisely because nature made us to be partners with soil instead of its masters. And so I'm here to present Regen Ventures. As you can see on my screen, just let me know when you're seeing the screen. Okay, so Regen Ventures is a fund supported by USA Conservation International and the wonderful team of the ICFA, and made by SVX Mexico. So as you can see in this graph, on the left you have the purple bars of the IPCC recommendations for what are the most effective climate solutions. And you can see the biggest bar is ecosystem restoration. And on the right you can see the green bars, that is where the actual climate finance allocation dollars are at today. So they are overinvested in tech, and they are overinvested in electric mobility. So we think ecosystem restoration and natural capital are massively undervalued, and I think it's because it's not very well understood. So the best investment opportunities are when you can find them when they're undervalued, and you can find a pathway for the upside. And so nature-based solutions for the climate crisis can either protect ecosystems, manage ecosystems, or restore ecosystems. And in Regen Ventures, we have found a profitable way to turn bad management that goes against nature into good management that goes aligned with nature and regenerates ecosystems and brings about climate resilience. So it brings both mitigation and adaptation, a cross-cutting advantage. So what are we going to invest in? We're going to be turning a vicious cycle from sustainable management that usually starts with monoculture, intensive use of agrochemicals in land use, and then goes into very high dependency on external inputs that are increasingly more expensive and that are bringing margins down for smallholder farmers, and this brings them to crop losses and a ton of communities that are growing in poverty, and so they abandon the rural lands. And we want to transition this into a virtuous cycle of regenerative management. And this starts with agroecological and biodiverse practices that improve soil fertility. When you improve soil fertility, of course, you increase yields and productivity, and margins with biological inputs increase precisely because they're way cheaper than the synthetic agrochemicals, and this brings climate resilience to both drought and flood events. So there's higher profits for the farmers, and there's prosperity for the local communities. And so in Regen Ventures, we've been an impact investing advisory firm since 2015, working in Mexico and Latin America, and we've catalyzed together over $45 million in impact investments and climate finance with a very special focus on gender lens, as my previous colleagues. And we launched Regen Ventures to invest from $20 to $30 million to transition rural Mexico towards regenerative management. And why did we choose regenerative management? Because more than 100 corporations and family offices, many of which we are talking to, are investing in it precisely because it's the intersection of the most effective climate solution that really has a very high social and environmental impact, and it's growing at such a speed that is amazing. Right now, the market value is at 9 million, and it's growing more than 50% every single year. So the way that we are looking for the upside in our pipeline, because these are profitable and successful companies, is that we have the organizations that touch the soil, the ones that are in the bottom layer, so like the smallholder farmer cooperatives, and then the ones that have the infrastructure to transform or add value to those commodities, then the regenerative game changers that are bringing to the retail markets and shifting consumer patterns and trends, and the landscape infrastructure, the ones that are building the ecosystem service, monetization, and bringing in the climate resilience for the landscapes. So some of those successful companies are, for example, this company that we visited in September, that is a high-quality carbon project ecosystem developer in over 12 Mexican states, another company that is helping transition out of the toxic agrochemicals into the biological inputs, and it's a women-led science company. So we're looking to invest in more than 10 to 15 Mexican companies through equity. This includes agriculture, forestry, fishing, ecotourism, livestock, so every single ecosystem. And we're estimating a return from 11 to 20%. We already have $11 million in soft commitments. And the reason why we're doing Mexico is precisely because of our experience, but also because it's one of the biggest geographies in Latin America, and it's the one closest to the biggest regenerative agriculture market, which is the US and Canada. And also, we're the 5th most biodiverse country in the world, so that's very important to keep. And we're doing this through the support of the Sustainable Landscape Ventures Partnership. It started in 2020, it's funded by USAID, it's implemented by Conservation International, and we have tons of technical assistance by all of these partners in marketing, in traceability, in accounting, and best practices. And our team is really diverse. We add up to 15 years of blended finance experience, more than 15 years of impact investing experience and gender lens experience. 3 of us have formal education on regenerative agriculture. 2 of us already know or have been transitioning landscapes in Mexico before to regenerative management. And basically, we're inviting all of our dragons and everyone here in the room to join the leading and systemic investors that catalyze biodiversity regeneration in Latin America, precisely because biodiversity is everyone's only life insurance. So thank you, and I'm open to questions, comments, and feedback.
Thank you, Laura. If I can give it to the dragons for maybe some insights and some tips.
A question maybe first.
Sure.
for the landscape regeneration or all the agricultural component of your what's the typical size of the land you will target?
So the ticket sizes start at $250,000, but the average ticket size that we want to invest, it starts at around $800,000 to $1 million. That's the average size. In terms of hectares, the difference between investing in Mexico in regenerative agriculture and other, for example, global north geographies is that in Mexico, land acquisition is not part of the investment strategy. Precisely because most rural land in Mexico is ejido or common land, so land acquisition is not part of the assets within the strategy.
Okay. And related to that, how do you manage land conflict and relationship with the local communities on the projects that do involve access to land and maybe change of practices?
Yes. So basically, what we're very fortunate to have been in this partnership with Conservation International, that they have been decades into these landscapes, and we have landscape managers that have the boots on the ground, and they're the ones doing the origination. So the relationships have been, developing for a while now, for years now. So for example, this year we have led 11 transactions in these landscapes. And it's precisely because these communities, the organizations that we're selecting are mostly locally led. So we're not bringing in somebody from the outside coming into the community, but rather supporting and partnering with the local community. So it's their own organizations. So it's really baseline communities, baseline organizations. The other risk mitigation strategy is that many of them are already going into an agroecological transition. So many of the pictures that you saw on the presentation are precisely some of the leaders of that agroecological transition. The thing is that they're doing it literally with their own blood, sweat, and tears, and not necessarily with the best, watershed management design. So when we come in with them, we really partner to their vision instead of imposing our vision. And we think that really mitigates social risk at the long term and governance risk.
All right, thank you, Laura. And I think we are now over time officially. So we want to wrap it up. Thank you so much, Laura.
Thank you so much. You can reach me on my email or I'll send a follow-up message. Thank you, ICFA.
So one last little question to our dragons. Do you have a favorite? Are you writing a check soon?
All of the above. The capital's there.
No, I think it was a very diverse universe of different fund strategies. I don't really have a favorite. I know what DEG is more inclined to do. That's more the typical renewable stuff. But personally, I like these kind of nature-based solutions more. And we are also doing this. But it's also the most challenging, I feel. Yeah, it's agriculture, small, but it's close to my heart.
All right. Well, this wraps it all up. I hope everybody here and online got a bit of a flavor of what type of projects we support and all the innovation that is happening in this particular field. So here at COP, we talk a lot. It's kind of the defining feature of the entire thing, but we're talking a lot about taking action. So I want to have a call out to all the investors, including the dragons here, to reach out to these teams. They're looking for further support. It's a hard journey to set up a fund. It takes a lot of time and a lot of effort, a lot of sweat, blood and tears, unfortunately. For anybody who's interested in setting up a fund, after that warning, please reach out to us. We're happy to kind of welcome you, guide you through our process. We have some flyers lying around as well with information, and everything is also on the website. And that wraps up this side event. Thank you so much for being here.